Greetings. Today is Monday, August 3rd, 2026. This is our Guardrails and Growth monthly update report. I want to start by looking at the S&P 500. On a monthly candle chart, we see what's called a doji. That candle on the far right is technically called a doji. And it is also representing the second month in a row of losses on the S&P 500. We're going to come back to that in just a minute. But before we go into the details of what's underneath the surface here, we want to point out something from our friends from Optima. What they're pointing out in their research is that a negative June and July has only happened 12 times since the S&P 500 was created. On average, those 12 times end up resulting in negative 2.5% return between July 31st or August 1st through the end of the year. So not encouraging news. They are also pointing out that there was one year, 1963, where we had a negative June and July, but then August through December 31, the S&P 500 was able to post an 8.5% rate of return. That's pretty good. But in 1990, it was almost just the opposite, where it posted a negative 7% return. Now, this is just one data set, but I want to pause right here and just say this is part of the reason why we believe so strongly in guardrails and growth. Because if we go back to the S&P 500, we look at this doji candle. One of the reasons I like candlesticks as opposed to bar charts is because we name the candles and there's a meaning. So when I look at that doji candle, it marks indecision. That's what it means. What it's effectively saying is the stock market participants are saying, well, we don't know. Do we want to go up or do we want to go down? That's what a doji candle says. We don't know what's going to happen, so we don't know what we're going to do. That's what a doji candle implies. And this is why we believe so strongly that it's guardrails and then growth. We want to protect the assets, protect the wealth that you have created. And then when it is conducive, then we want to grow that wealth. But we got to put that guardrail in first. So what's going to happen next? Well, let's start to answer that question by broadening our view. Instead of just looking at the S&P 500, let's look at the Russell 3000. It captures a far greater swath of the United States stock market. First thing you'll notice is we see that doji once again. I've marked the chart Indecision in the Russell 3000 as represented by that doji. So let's take this monthly data chart. Let's take that monthly chart, turn it into a daily chart. And I'm going to tell you this candle right here, that's some encouraging news. That is Friday, July 31st. That is the last trading day of the month. And in stock market psychology, the closing price is more important than any other price. So in this case, that is the closing candle, the closing price for the month of July. And you can see this little bit of leakage. We'll call that leakage. That's a technical term. We'll call a little bit of a leakage in the S&P 500 and the Russell 3000 coming off. But Friday was able to rally fairly strong. And if you understand how you read these candles, the wicks, the top and the bottom portion of the wick, that's the entire range for the day. So the bottom part of the body, that's where the Russell 3000 opened for the day, and it traded down all day, and then it started to rally and go back up. It actually took out the high and it settled back in. That is a pretty strong rally to close out the month of July. I'm going to call that pretty good news. Let's broaden it even further. Let's look underneath the surface at the advanced decline line. Remember, IWV does look at a much wider stock selection of stocks. It's a much better indication. However, it is also cap weighted. So you really need to look underneath the surface. This is the advanced decline line. These are advancing stocks minus declining stocks. And we're not really seeing any breakdown here. So I'm encouraged by the shape of the advanced decline line here. But let's take it one step further. We're still looking at IWV. We've flipped back to monthly data because I just want to consolidate it. This green bar represents the number of stocks in the Russell 3000 that advanced in the month of July, and this is the number of stocks in that universe that declined. So you can see 1,600 advanced, only about 1,100 declined. So more stocks advanced than declined, even though the IWV was technically negative, or you could argue borderline flat for the month. So this is the data that I want to see. I'm encouraged by that data. So the next thing we want to look at is just a year-to-date perspective on several different indices. I've got that now on the screen. The good news here is we've got small cap IWM, that is the smaller companies, that is still leading the charge year to date. You can see here lately, so what is this, mid-June into July, we've had, again, we use the technical term leakage. It's come in a little bit, but that's okay. So you've got small caps, and RSP is the equal weight version of the S&P 500. They are at the top of the leaderboard. That's encouraging news. It's no longer just the Magnificent Seven that have been pulling the S&P 500 up for so long. That's really been struggling. Magnificent Seven is technically back to positive now after the end of the month. But take a look at this. This is AGG. This is the aggregate US bond index ETF, still negative year to date. And that's where we need to pause and spend a little bit more time today. So last Wednesday, new Federal Reserve Chairman Kevin Warsh announced that the Federal Reserve Open Market Committee is going to leave interest rates alone. The stock market breathed a sigh of relief. But why is that important? Well, we're going to talk about risk-off behavior. And I talk about this a little bit in my book, Evidence-Based Investing, which is available on Amazon. If you haven't read it, feel free to check it out. You can also get the introduction and the first chapter of my book free by going to theodorehicks.com. That way you can see if you like my writing style before you spend any of your hard-earned money on my book. But I talk about this a little bit in my book, that I believe that we are in a different regime. Most of the people that are going to watch a video like this grew up accumulating wealth in an environment that was largely defined by declining interest rates. We're going to talk about that and how that's not true. First, I want to show you something on the screen right now. I've got TLT. This is the long-term or 30 or 20 plus year Treasury bond ETF. And what I want you to see is that TLT is still down about 52% from those COVID highs. Now, my friend Dan Russo over at Potomac, he tweeted this out last week. I believe it was on Fed Day, or when Kevin Warsh made that announcement. And he makes the comment that today was a risk-off day, or that particular day was a risk-off day. And what does he mean by that? Well, when everything is going down, when stocks are going down, gold is going down, when everything is going down, it's just take the risk off. That's a risk-off day. When everything is going up, that's a risk-on day. And so this particular day was clearly a risk-off day. And I'm going to show you what happened in the bond markets. But notice what he's saying. We are now in a position, or you, dear reader or viewer, you are now in a position where you have to make active decisions while claiming to be a passive investor. There's still so many people out there that want to cling to a buy and a hold mentality. And let's set up an asset allocation and we're going to leave it alone. I don't think that works. I go through this again. I talk about it in my book in a very easy to understand manner, that the theory that creates this mindset it doesn't work in reality. And when you factor in current market dynamics, this is really dangerous behavior. So what happened on this risk-off day? Now on the screen, I've got Treasuries again, TLT. So this is still the long-term bond, but that is a risk-off day. That's the risk-off day. And so that is a very negative candle. Now I explained how to read a candle a minute ago, but now I've changed the formatting. So let me make sure you understand what you're looking at. In this color scheme, red represents a down day, green represents an up day, but furthermore, that body is colored in. So it's not just red, it's full-bodied red. What that means is TLT started the day here. It traded up just a smidge, but then just traded all the way down, and it was able to rally a little bit off of the close. But for the most part, TLT had a really bad day. Now, again, This is a bond. These are bonds. These are the modern portfolio theorists. This is the sector. These are the sectors that people say these are risk free. There's no risk in government bonds. Well, that looks pretty risky to me. And again, you go back and you look at the longer term chart, which I've got right here. We're down 52% for what, 6 years? That doesn't seem like it's risk free to me. And so part of the whole argument that I make in my book and when we're managing assets for clients is we believe strongly that managing risk needs to be done actively, and you have to do it in a manner that's different than what most people are used to. Most people want to manage risk by increasing or decreasing your allocation to bonds. I don't think that's wise because we have a risk off day just last week, and bonds, which is traditionally a safe asset, bonds had a very bad day. Now, why is this taking place? Well, the reality is the secular environment has changed. On the screen right now, I have the Fed funds rate going back all the way into the 1950s. And what I'm trying to show here is that from 1955 or whatever through 1980, perhaps, they were in a rising interest rate environment. I would call that a secular bull market for rates, or a bear market for bonds. Now, what do I mean by that? Well, remember, the interest rates and prices of bonds are on two sides of a teeter-totter. So with a bond, if you've got rising interest rates, bond prices are going to go down. If interest rates go down, bond prices are going to go up. They are a teeter-totter. They're sitting on the same, some call it a seesaw. You're sitting on the same seesaw. One goes down, one goes up. So if interest rates go up, bond prices go down. But most of the people that have been watch our videos, this is the environment. This green arrow, that's the environment that you grew up in. And that is a declining interest rate environment. So if interest rates are declining, bond prices are rising. So historically, while you are accumulating your wealth, you could manage your risk by allocating some to bonds, because on a risk-off day in that type of environment, bond yields go down, bond prices go up. That's not true anymore. Back in 2020, we had a secular trend break. Now we are arguably in a rising interest rate environment. Now, again, this green arrow, that is a bull market for bond prices. Yields are going down, but again, yields are going down, so bond prices are going up. That's a bond bull market. But we crossed that Rubicon here. We're no longer in that environment. I'm not comfortable saying that we're in a bond bear market, but we are definitely not in a secular bond bull market. So you have to treat risk differently. Now, one more thing and we'll land the plane for today. On the screen, I've got two data sets. The blue line is the 2-year yield, and the green line is the Fed funds rate. I've shown this multiple times. I'm just trying to highlight that there is a lot of correlation between these two data series. So what's going on right now? Well, if you zoom in, again, the blue line is the 2-year yield. That's the yield that is being set by the market, versus the green is the Fed funds rate that's set by Kevin Warsh and the Federal Open Market Committee. And so if you look at this, there's a divergence here. The bond market is suggesting interest rates are going to rise. Now, so far, that's arguably why everybody breathed a sigh of relief on Wednesday when they kept interest rates alone, because the bond market has been foreshadowing the yields are going to go up, or the interest rates are going to go up. So far, that hasn't happened. And one of the economists that I read, I won't get into it for now just because the video is already too long. One of the economists that I read, I tend to agree with him that I think the inflation fears are going to start to subside a little bit more. I think inflation will come back down, and maybe we can hold off, or Kevin Warsh can hold off on raising interest rates. But the main point that we need to take away from this is that we are no longer in a bond bull market. If we're going to manage risk, in my opinion, we have to manage risk actively. And that goes right back to where we started. It's guardrails and then growth. We want to put the guardrail around the wealth first, and then we're going to grow it. And we're not going to do it by using theories concocted in the 1950s that all the evidence suggests just don't work. Thanks for watching.